Hi, this is Sean. This is a tutorial video on a property analysis tool which can be used for American investors. It differs to the one I've created for South Africa because there are different costs involved. I found a breakdown on one of the websites that just gives us an indication of what costs there are. So I've just done a essential example here where I'm not 100% sure if figures are accurate because it is in US dollars. You're welcome to then take this template and put in figures that you work with on a monthly basis. But essentially, I'm working on a property where I've taken an example of a $300,000 purchase price, and the owner's cost or owner's money was around $3,000 in this particular example. The closing cost was $6,000. Obviously, you can um, change it, of course, if there's additional attorney fees, home inspections, home appraisals, etc., commissions, all that stuff you can put in here. And then there's prepaid taxes and insurance. And what this does, including the down payment, I put a down payment of 10%, is it takes the down payment, which in this case is $30,000, and it adds these all together and it pulls it through over here because that's going to be the capital outlay when we do the calculation for net present value, which is what I'm going to get to. So in this case, we're taking a property hypothetically of $300,000. The expected rental per month is $2,500. Garbage, electricity, gas, property taxes. Again, you're absolutely welcome to changes. I have used interest rate of 3%. I'm going to make it 6% just in this case, because I know that the USA does have a very high interest rate at the moment. This is the installment calculated on the balance, which in this case is $270,000. I said yeah, the appreciation is 3%. Inflation escalation, sorry, rental income is 3%. I can change this maybe to 4%. Again, you can change this. The rental management, I will take off. So in other words, if you have a person managing your property for you in terms of collecting rentals, placing your tenants, you can put a percentage of your rental that will go towards that. So hypothetically, in this scenario, if this was feasible property, there'll be a surplus of $121 per month, which equates to $1,454 for the year. And the market value of this property has grown by 4%, so it's $212,000. And it's just an amortization calculation based on a 30-year term interest rate of 6% and a loan amount of $270,000, which means you can see it starting to reduce over here. And this is the equity, which is the balance between the market value minus the outstanding bond, the difference rather. And then there's just intervals over here for 5, 10, 20, and 30 years. So you can see just milestones. What is the equity in this property as this property appreciates in value, and also the property starts to pay itself off. Now, of course, everyone's got their own specific criteria. So if you want to put in any additional cost in here, if you want to factor in, for example, maybe 2 months vacancy, so after 12 months in a year, you might have 2 months where it's empty, the property is empty because you are either doing renovations or whatever the case is, the tenant's moving out, or you just want to stress test how much of potential loss can I make on this property. Obviously, factor in all the expenses you've already put into it. You could have also factored in maintenance. But in this case, we're just going to leave it on 0 for now. But if you do change it, it'll automatically then update the the break-even point and also the vacancy rate. Vacancy rate simply means that if it's 1 month vacant for the year, then your basically it's proportion to 11 months equivalent, which can, if you see over here, it'll automatically update that. So instead of being $2,500 a month, it brings it down to 2,291 or 92 if you round it off. So I'm just going to leave it on note for now. So that's the first metric. The second one you can look at over here is you might want to look at the gross yield. Now, the gross yield and net yield, I have pegged it to the purchase price. And the reason for this is because one can just see what is the yield of the property over time as the property appreciates at a rate of 4% a year. you can see that it starts to grow gradually because that is the initial outlay, $300,000, the purchase price. Because now this is measuring what is the property growing at. That's the yield of the property. I'm not factoring in the cost because that's going to be pulled into the net present value and internal rate of return, which is another way to measure the property's feasibility. The net yield. So obviously, if the inflation rate, for example, is 4%, and you're getting a yield of close to 7%, and that's gradually growing, then it can be seen as a good property. The rent to value is 0.8, which means that $2,500 is 80% in proportion to $300,000 purchase price. So in other words, if this was a $3,000 rental per month, then you'll be as close as possible to getting that value over there. Just made a quick tweak. So if it's $3,000 a month, that means it's directly proportionate to the purchase price. In other words, this property is directly in line with what you've paid for it. And that gives you an indication of the break-even point, but also the feasibility to refinance this property because you're going to be generating a surplus sooner rather than obviously paying later. And to illustrate my point, let's say the rental was $1,800 a month, and you had a rent to value of 0.6 or 60% in proportion. It would mean that your break-even point is 12 years versus what I originally had, which is breaking even immediately. Or if the investor got to 2, the break-even point is 3 years, 0.73. Generally, 0.85 and above is a good ratio, because it means that the property, or 0.8 to 0.85 is a good ratio to have if you're looking for a property that is generating rent relative to the value. Because it means that as the property appreciates in value, the rent needs to also keep up. Otherwise, you get to a point where the property could be growing at a much higher rate than what you can escalate the rental income by. And that generates a problem because you're generating equity, which are unable to finance that equity because your cash flow is not growing in line with your property. So based on this example, you're looking at a 0.83 across all the years, because I'm just keeping it as a standard amount. And this is based on originally the purchase price, as you can see, here's the formula. And then from there, it goes on to the first year, because this is the value after year one, which becomes the market value for the beginning of year 2 and so forth. Return on investment, this is the formula for that. Return on investment essentially is looking at the growth of the property. There's an example of a formula there. The return on investment is just one metric that one can use, but it's not a true metric because you're always going to be pegging it against the purchase price. The break-even ratio, obviously this property is broken even, so it's 105% of the break-even point. In other words, if the rent was lower, so it was $2,000 a month, then your break-even point would be 84%, and then eventually grows to 100% in year 8. So again, if you're comparing properties and you want to see which one is going to break even, then that would be a good metric to use. Another one is a cash on cash return. Here's the calculation for that. We are taking the surplus amount, and we're then going to divide that by the initial F8, which is over here. Now, just note, obviously the cash and cash return is on the deposit. We can factor it in. I haven't, because this is directly linked to the property. I don't want to bring any other costs in because these are external costs that are not linked to the performance of this property. In other words, if you were to buy 2 separate properties, you want to compare the property itself, because this is once off and then it goes away. This, however, is linked to the property. The down payment is what's going to the bank to fund this investment. And that's why I've separated the down payment and the additional cost over here, because this is specifically linked to the property, because you're gearing this property, and we want to see what the returns are by gearing this property. In other words, if you bought this cash, then you will put 100% in here, and you may have much lower fees, etc. But again, I'm just linking it to the properties in this particular section over here. The loan to value, obviously now you can see the loan to value is starting to drop because the property is now getting to the point where it'll break even. It is over a 30-year term. So if I were to go and change this to 20 years, for example, what it'll then do is it'll then show you the loan to value go to zero after 20 years, not 30. So you can change the loan term amount if you want to any amount you want to see how it's going to impact the cash flow. As you can see, when I changed it to 20, it went to a negative per month. A person might want to pay the bond off sooner, and therefore they can cover the cost for the first 3 years based on these assumptions, and then they'll start making a surplus and pay the property off sooner. Otherwise, they might decide to just have a longer term and let the tenant pay for that over the 30 years, or they can reinvest additional capital into the bond and pay it off, the mortgage rather, if they need to. So I don't know, over here, capital appreciation rates, debt to equity, as the property is tapering to pay itself off, obviously the debt will go to zero. It'll go to zero if it was over 20 years. So these are just some metrics over here. Here's the glossary if you want to just read up on what these are. There are many more ratios one can use. This is just some of them. What you can basically do is you can have this template and you can save it on a PDF and compare two properties that you're analyzing and just keeping track of and see which one has the better ratios based on these formulas. And then one can make a decision whether or not the cash flow might look good in one area, but then the returns might be better because you might be getting, for example, a better appreciation rate. It might be a better area in which you're buying the property in, or similarly, you might be getting better return on your rental. Your rental escalations are growing at a much higher rate. And as a result, it'll change these figures over here, which you can then compare. If you wanted to find out what is the feasibility of this property, if I use a net present value and alternative return calculation. So essentially what the net present value is, it is a way to measure whether or not a property or any investment really is worth pursuing based on cash flow projections and discounting those cash flows back to present terms. Because when you look at these cash flows over here, these are all increasing into the future. So this is not the same buying power in 6 years as it is in today, because obviously this is now being escalated by 4%. So what I'm going to show you now is the outlay of this property, as I've said before. So 30,000 plus these additional expenses, which is $11,500. If you add those on, it's $41,500 is what you need to pay upfront. So that is the opportunity cost that you need to incur to buy this property. So if you've got $41,500 to get a $300,000 property, you can then do a cash flow projection 10 years from now and 20 years from now, and then use an alternative return calculation to determine whether or not this property is feasible. So in this case, we're using a discount rate of 6%. I just worked that as inflation in the US as an example. The discount rate is also known as the working average cost of capital. It's defaulted to the rental, but again, you can use any percentage you want. A lot of people will use a higher percentage because they just want to factor in the cost of running the portfolio, maintenance, all these different things, which might be growing at a higher rate. They might put a higher amount in. I'm just going to work on 6%. So if we take the cash flow and we pull it through over here, as you can see, we've taken the cash flow from 1 to 10, as well as the equity after 10 years. And we've then discounted it using a factor of 6%. So we've discounted this cash flow by 6%, and you can see the formula there. And we can see that the present value of $218,000 is $114,000 in today's terms, which is obviously in 10 years from now. And then I've used a discounting factor of 6%. So you can see here that because there's a positive cash flow, this investment is worth pursuing using a discount factor of 6%. If I change it to 12% and there's still a positive, it is worth pursuing because you're making a return. This is the net present value, and this is the return, the difference between. So this amount is greater than the capital outlay when you discount it back to present. So you're going to make a return of $48,054. So it makes sense. Where the internal rate of return comes in is we take the cash flow as before, and then we do a separate internal rate of return formula. And then we use that formula. And if you press the macro here, what it'll then do is it'll take this net present value and it'll copy and paste it automatically into the discount rate. So now your working average cost of capital equals your alternative return. So what this means from an investment point of view is if you discount the cash flow up to 21.75%, this property will have a net present value equal to the capital outlay, which means the return is zero. In layman's terms, if you made this 22% and you made a loss of $740,000, this means this property is not worth pursuing. Because if you kept the property for 10 years and you discount the cash flow and you work out the net present value, you would make a loss of $740 over the 10-year period, which means this property would not be worth keeping. So I'm going to put it back on 6 to show you that in this case, working on a 6% discount rate, it is worth pursuing. And over a 20-year period using the same 6%, you're going to get a return of $216,000 because I've now factored in additional 10 years, which I did also discounted by 6%. Again, if I press the macro and I run the internal rate of return into the discount rate, 19.54%, your return is zero because now your net present value equals your capital outlay. And that just simply means that you'll need to discount over 20 years, 19.54% into your equation. So this is a good property because you need to discount it by quite a large amount for it to actually not be feasible anymore. So that's another way to measure a property. If you want to compare two properties, if one's got more capital outlay than the other and the numbers look good, you can factor in two different scenarios of using the net present value and then alternative return and see which one over 10 and 20 years is better. The last one here is just the leveraging component where we want to see if we compare this property, and I'm again using the property here compared to a traditional investment. In essence, I could, if I really wanted to, I could factor in the other costs, but it doesn't make much of a difference because the message here is we want to compare how does leveraging work compared to traditional investment. So we are taking a traditional investment, $300,000 is the purchase price, 5-year term, 4% growth rate. This is what the growth would be after 5 years if you invest this money into, let's say, an income fund or even money markets. Similarly, over 10 years and 20 years, this is what the future values would be. And then obviously the internal rate of return would be 4% because there's no additional money coming in and it's compounding annually. So that would be the internal rate of return. However, with property, when you run the scenario over 5, 10, and 20 years using the internal rate of return, the calculation for that, you will see that over 5 years, the internal rate of return is 30% compared to 4, 26 compared to 4, and 23 compared to 4, even though your future values are the same. And the reason why the future values are the same is because we've used the same growth rate or capital appreciation as the growth rate that you would have had in a money market or a fixed deposit or whatever. The difference really is that you're gearing this. You are not putting $300,000 into an investment. You're only putting down $30,000. And that's how I want to illustrate that. If I were to go and put in these additional expenses over here, we could do that. It would obviously have a different yield, but the point being is this is a way to explain how traditional investments would differ to property when you're comparing the opportunity costs over here. If you now look at how does the year compound interest return work, so the future value after 5 years is $364,996, which is over here. Your equivalent deposit is $30,000, which is the down payment. So if you were now to do a calculation and say, if I had $30,000 and I put that into a fund, and I got to a future value of 364,996, which is the market value of the property after 5 years. We need to have a compound return of 65% every year, over 10 years, 31%, and over 20, 15%. So this is a bit more realistic if you put it into a share portfolio on the S&P 500. But the point I'm making is that you would need much more time to do that compared to a property where you're leveraging. And the reason for this simply is you're leveraging 90% from the banks, putting down a down payment of 30,000, and this is how you would then compare it. Two graphs over here is the internal rate of return and also just the equity proportionate to market value. The equity obviously is very low because the outstanding bond, outstanding mortgage is quite high. As time goes by, the outstanding mortgage eventually starts to go to zero. And if this is a 20-year mortgage, so I'm going to show you what would happen. All that would happen is that the property after 20 years would have an equal, your equity will equal your market value because there's no bond, there's no mortgage anymore. The mortgage is now being completely paid off. So you've got all this time now to refinance your portfolio. Obviously, you could do it much sooner, but it just illustrates to you what happens if you pay the mortgage off sooner than 30 years in that particular scenario. The last one here is just an internal return. Internal rate of return is impacted by the financing terms, also the deposit or down payment. So essentially, I've said here, internal return is a metric used in financial analysis to estimate the profitability of potential investments. In other words, how hard is a capital invested working to generate a return? Internal return below is derived from a 10% deposit or down payment, 30-year bond term and interest rate of 6%. The lower the deposits and interest will increase the internal return. So what that simply means is if you look at the internal return on a 90% geared portfolio, it's 25.35%, 30.57. And if you were to compare it over here, those figures have been pulled through from over here, but I've actually got a back end formula, a whole table, which does the internal return over 20 years. And if I go now change this to, let's say, a cash purchase, there was no finance or no mortgage, you would see that your internal return comes down significantly because you're not gearing anymore. So you can see now that you can outperform this property if you were to put this into a share portfolio, and also your internal return, as you can see, now comes down to 9.72%. So it becomes a lot less attractive in terms of the feasibility of this project based on using the net present value. And if you use a discount rate of 9.72 over 10 years and 10.35 over 20, this property is no longer feasible. Similarly, if you now compare it again, if you're buying the property cash and put your money into a portfolio, if the property is only growing, appreciating at 4%, and you can outperform 4%, then it might be in your best interest to put your money into an investment vehicle. Obviously, you can factor in the cash flow as well, which in this case we have not done. Obviously, if you were to add the cash over and above the market value after 5, 10, and 20 years, that would change the result. But that's why you can use the net present value and the internal rate of return over here. So there's a few ways to measure it. You might have your own way of doing it, which is perfectly fine. But I do want to illustrate to you that the more money you put in from an internal rate of return point of view, your returns come down. On the converse, if you were to somehow get this property without any down payment, your internal return would be very, very high because you're putting, in this case for the property, nothing up front. Again, bear in mind, you do have this $11,500, but it's not going to make a huge difference. And that will then result in the property itself. Again, we're measuring the property's return. This is external to the property. This is part of the property because you're gearing the property. This is paid to the seller. This is paid to the attorneys. This is obviously paid to the revenue service, etc. So this is not part of the property. It's something that could potentially be negotiated, whereas this is a metric on the property, which is why we're measuring that. So this template can be used to track and measure. There's a few other graphs over here. This is just the outstanding bond or mortgage, the market value of this property. As you can see, the outstanding bond starts to come down as time goes by, and you'll see the outstanding bond over here starts to reduce, and the equity starts to increase quite significantly. So you can see there's a large amount of equity, which is taken from over here. Your mortgage is paid off. You've got $973,019 in the future that you can use to purchase. Obviously, bearing in mind it is in the future, so whatever the price of the properties are in 30 years, that's how much you would have to potentially buy, or whatever the case is. And this is the relevant cash flow per year, $43,000. So you'd have to acquire quite a few of these properties to build up a retirement nest egg for yourself. But at least this gives you a bit more information to work with before you decide to purchase. So I hope this templates can add some value. If you have any questions or suggestions, you're absolutely welcome to drop them in the comment section. This is just a starting point based on what I've read up on the US properties. But if you have any information or that you could pass on to me, I would also appreciate it. More than happy to update this template accordingly to make it a lot more valuable for those who are looking to invest in property in the United States. Thanks very much.